Good morning. I'm Teacher Teresa. Welcome to our business lesson. We'll start with topic one. Our topic one is supply. Supply is defined as the quantity of supplies that are willing and able to take to market at a given price over a given period of time. Factors that influence supply of a product: the price of a product. The higher the price, the higher the supply, the lower the price, the lower the supply. The cost of production. An increase in cost of production leads to a reduction in the supply of goods, while a decrease in the cost of production leads to an increase, in the supply of goods. The level of technology. An improvement in the level of technology leads to a reduction in the cost of production and an increase of supply. Supply schedule and supply curve. A supply schedule is a table showing the relationship between supply of a commodity and its price. It shows the quantity supplied at various prices. The supply curve is a geographical illustration showing the trend taken by supply as price either it increases or it decreases. The shift of a supply curve is when the entire curve moves either to the left, right, or to the right as a result of changing factors influencing supply other than the price of the commodity involved. Other than the price of the commodity that is involved. We'll go to topic 2, that is size and location of a farm. Now, the meaning of a farm and industry. Now, a farm is an individual enterprise or business unit under one control or ownership. That is, for example, a business unit carrying the production of a good and service, such as production of a soap or a legal service firm. A farm is a single business unit or an enterprise under one ownership, management and control, for example, KCC, Brookside, etc. An industry consists of all those firms producing the same type of product in the same line of production. A soap industry consists of all these firms producing soap, while the insurance company consists of all the firms producing insurance services. An industry refers to a group of firms producing the same product for a given market, e.g., the milk industry, which includes farms like KCC and Brookside. In some cases, where we have a single firm, the firm becomes the industry. Factors that influence the decision on what goods and services to produce: profitability, level of competition, cost of production, demand of market. Now, let's look at location of location is a site or place from which a business operation or farm will be established. The management has to make appropriate decisions concerning the location of a farm, since a good location will lead to success, while a bad location leads to a failure of a business enterprise. Factors that influence the location of a farm. Raw materials. The availability of raw materials is one of the factors that determine the location of a farm. Farms should be located near the source of raw materials when the raw materials are heavy or bulky to avoid high transportation costs. When the raw materials are perishable so that they ensure they get to the farm in fresh. The competition for the raw material is high, should be located near their sources so as to ensure that it gets all the resources that is required at all times. Transportation cost of raw material is minimized. Storage cost of raw material will be minimized. That is if they are located near the farm. It is easier for the farm to select the quality of raw materials required. Easier to get fresh raw materials and undamaged raw materials. Production process can be uninterrupted because the consistent supply of raw materials, thus consistent production. We'll go to topic 3, localization and delocalization. Now, localization of a farm is a situation where many farms are concentrated at a particular place or area, while delocalization is when a farm is a situation where locations of farms is spread in different regions to minimize the problem of localization. Now, some of the advantages of localization are farms will benefit already from the established skilled labor pool. Another one is farm will benefit from already established infrastructures such as transportation, communication. Farms will also benefit from auxiliary services. Farms that may have already been established will have those. And then such areas have social amenities such as hospitals, schools, and then employment is created in such areas. Now, disadvantages of localization are some, as many people move to such areas in search of job, slums are created. Land becomes very expensive in such areas. Congestion and traffic jams are a common problem in such areas. In case of war, such areas can become a target of attacks, leads to rural urban migration, leaving the old and the young in the rural areas. So ways in which the government may motivate industries to delocalize: by giving entrepreneurs free and cheap land to construct their factories, by giving tax incentives to those who locate their industries in delocalized areas, by giving cheap loans to entrepreneurs wishing to establish their business in areas in few industries, by providing security in the new industrial areas, by providing subsidies to those industrializations, by providing the appropriate infrastructures in the area, by providing social amenities such as schools, hospitals in those areas where delocalized industries are established. The last one is by offering financial assistance to the delocalized industries. Let us look at economies of scale. Now, economies of scales are the benefits of a farm or industry drives from expanding its scales of production, or the advantages of operating in large scale, in short. But there are two types of economies of scale. There's the internal economies of scale, and we also have the external economies of scale. Now let's look at the external diseconomies of scale. These are the demerits that a farm experiences as a result of growth of the entire industry. Now they include scramble of raw materials, unavailability of land for expansion, scramble for available labor, competition from available market, easy target, especially in times of war. Now we'll go to topic 4, which is product market. Now, the term market is usually used to mean the place where buyers and sellers meet to transact business. In business studies, however, the term market is used to refer to an interaction between a buyer and a seller, where there is an exchange of good or service for a consideration. Now, let's define some of the terms in product market. Now, what is a product market? It's a particular market in which specific goods or services are sold and with a particular feature that distinguishes it from other markets. The features are mainly in terms of number of sellers or buyers and whether the goods sold are homogeneous or heterogeneous. Product market is also referred to as market structure. Markets may be classified according to the number of farms in the industry or the type of products sold in them. Types of product markets that we have the perfect competition, pure monopoly, monopolistic competition, oligopoly. Now let's look at the perfect competition. The word perfect cannot it's an ideal situation. This kind of situation is, however, very rare in real life. A perfect competition is therefore an hypothetical situation because it's rare in real life. This is a market structure in which there are many sellers and many buyers who produce a homogeneous product. The action of any firm in this market has no effect on the price and output level of the market since its production is negligible. Monopoly, on the other hand, is a market structure in which one firm produces a commodity which has no close substitutes. Some of the features in these market structures are one seller to produce, many unorganized buyers. The monopoly firm is the industry because it supplies the entire market. The farm supply curve is also the market supply curve, and the demand curve of the farm is also the market demand curve. Entry into the market is closed. Such barriers are either put by the farm or they result from advantages enjoyed by the monopoly firm, e.g., protecting by they are protected by the government. Topic 5. Topic 5 is chains or channels of distribution. Introduction part. Now, channels of distributions are the parts that goods and services are following. The person involved in the distribution of goods from the producer to the consumer is called an intermediate or a middleman. Now, there are different channels that products follow. Some of the channels include from the producer, agent, wholesale retailer, producer, corporate, social marketing board, wholesale retailer, producer, market board, wholesale retailer, producer, wholesale retailer, producer, wholesaler, consumer, producer, retailer, consumer, and producer, consumer. Now, costs incurred by middlemen while distributing goods, buying costs, transportation cost, storage cost, advertising or marketing cost. These are some of the roles of middlemen. The following are some of the roles performed by middlemen in the chain of distribution. Bulk accumulation. They assemble goods from different producers in small quantities and then offer them to large quantities and then reduce transaction. The interaction between the producer and the consumer will be reduced since the middlemen are the ones who will communicate to the consumer. They also break bulk. They buy in large quality and then they sell in small quantities. They're also risk takers. They'll assume all the risks related to the movement of the goods from the producer to the consumer. Now, some of these risks, some of these risks may include theft, damages, loss due to bad debts, and then they also the last role that they play is the financial provision. The middlemen provide finance to the producers by buying goods in large quantities and paying them in time. Now, some of the factors to consider before selecting a distribution channel. Consider the product nature. Consider the nature of the market, the role of the intermediary, resources and size of the farm of the producer. Let's go to topic 6. Topic 6 is the national income. This is the total income received by the producer or the owner of the factors of production in a given country over a given period. Now, these are the terms that are used in a national income. We have gross domestic profit, the GDP. This is the total monetary value of all goods and services produced in a country during a particular year. Such goods and services must have been produced within the country. Domestic. Now the other one is the net domestic product, NDP. This is the gross domestic product less depreciation. Depreciation now, on the other hand, is the loss in value of an asset such as the machine used in the production of a good or service. And the third term we have is the gross national profit product, and GNP. It measures the total monetary value of all goods and services produced by a person of a country, regardless of whether they are in or outside the country. And then the fourth term is the net national product, NNP. It recognizes the loss of value in the capital used in the production of goods. Now, capital here refers to capital goods, and the net national product is the difference between the gross national product and the depreciation. And the depreciation, we said, is the loss in value of an asset. The last term here is per capita income. It's the average income per head per year in a given country. It is also the net income. It's also known as the national income divided by the population of the country, since it's done per head. Now the circular flow of income, it's the consistent movement of income between the household and the farm. The factors of production are received from households. The farm may pay the rewards such as factors to the household, expenditure to the farm, and the income to the household. Now the household in turn use the income to buy the goods and the services produced by the farm. That is to say, expenditure of households and income to a farm. Now these are some of the factors affecting the circular flow of income. This takes place when the households do not spend all their income on the purchase of goods and services. It reduces the income to be received by farms, hence saving is withdrawal from the circular flow of income. Another factor is taxation. Taxation reduces the amount of money available for spending. Therefore, it is a withdrawal or a leakage from a circular flow of income. Another one is the government expenditure. The government may buy goods from the farm or produce subsidies. This will relate in to the injection into the circular flow of income. And then the fourth one is when farms put more capital into the production, output will increase, hence increase in the income. That is the injection. And then the last one is when goods and services are bought from other countries, money will be spent, hence reduction in the circular flow of income. Now, when this happens, it's called the withdrawal. Now, these are some of the approaches used in measuring national income. Expenditure approach. National income is arrived at summing expenditure on all final goods and services. And then there is the expenditure on consumer goods. There's expenditure on the capital goods. Then the expenditure on the net exports. Now, these approaches, like for instance, the expenditure on consumer goods, the symbol used for it is C, and the expenditure on capital goods, the symbol for it is I, and then the symbol for expenditure on net export is X minus M. Now, therefore, how do we calculate the national income? Now, to calculate the national income, you'll have to add the expenditure of a consumer good plus the expenditure of a capital good plus the expenditure by the government. And then you add it to the expenditure on the net export. Now, on the net export, the symbol for it was X minus M. Now, these are some of the problems associated with the expenditure approach. They lack accurate records, particularly in private sectors. The next one is approximation of expenditure of the subsistent sectors. The third problem is difficulty in differentiating between the final expenditure and the intermediate expenditure. And then the double counting may exist. Fluctuating exchange rates may cause problems in the violation of imports and exports. And then we also have the income approach. In this method, the national income is arrived at by summing all the money received by those who participate in the production of goods and services. Now, some of the problems related to this method are determination of what proportion of transfer payments constitute in the income of a country. Inaccurate data may exist since business people may not tell the truth about their income in order to evade taxes. Plus, price fluctuation may make national income determination difficult. And then income from legal activities is not captured. And then the valuation of income from substitute economies may be difficult, for example, housewives. We go to topic 7, and our topic 7 is population and employment. Now, population refers to the number of human beings living at a particular region at a particular time. The size of a population is ascertained through national head counts, which is referred to as the national census. It is an international requirement that each country must have a national census at least 10 years. Now, the population issues are major concerns to business people because people are consumers of goods and services, as well as providers of the factors of production. Some of the basic concepts in population are the fertility and the fertility rate. Now, when we talk about fertility, it means the ability of a woman to give birth to a living child, not the word living child. And then when we also talk about the fertility rate, it refers to the average number of children born per woman during her childbearing years in a given population. Now, the childbearing years for a woman is up to 45 years. Now, some of the factors that determine fertility rates are the literacy level among women, the marriage rate among people in a productive age bracket, cost of bringing up children, economic significance of a large family, e.g., children seen as a source of cheap labor, cultural beliefs where many children were a source of prestige, availability of medical facilities, religious factors, for example, where religion prohibits use of family planning and all that. Now, some of the factors that may lead to a decline. Now, those are the factors that may lead to a rise. Now, some of the factors that may lead to a decline in the birth rates. Number 1, delay marriages due to such things as staying in school for longer period. Craving for higher standards in living, leading to people having fewer children, where small families are considered fashionable, use of family planning methods, availability of retirement schemes, making people to stop children as security in old age because now they have the retirement benefits. And then now let's look at the mortality or the death rate. It refers to the number of people who die per thousand people per year. It's also known as the natural attribute rate and may be calculated as the mortality rate can be calculated as the number of deaths times 1,000. Now, the total population infant mortality rate. It refers to the number of children deaths per thousand children below the age of 1 year per annum. That is below the age of 1 year per year. 1 year per year. Population growth rate refers to the rate at which the population of a country is increasing or decreasing. Let's go to topic 8. Now, our topic 8 is on the ledger. Now, a ledger there is a special ledger which is used to record cash and checks transaction. It contains only the cash in hand and the cash at bank. Cash in hand and cash at bank accounts. Now, some of the accounts in ledger are the nominal ledger, private ledger, the general ledger. Now, let's get to understand what they are. Now, nominal ledger, this is a ledger used to record business expenses and incomes. In other words, they used to record the gains in a business. It contains all the nominal accounts. And the private ledger is used to record private accounts. It's very confidential and valuable fixed assets of the personal accounts of the proprietor, such as the capital accounts and the province account are detailed. And then we also have the general ledger, which contains all the accounts that are not kept in any other ledger. That is the building, the furniture, the stock account. And then we have a personal account of debtors or creditors who do not arise out of sale or purchase of goods and credit are found in the general ledger. We also have private accounts. These are accounts that the business consider to be confidential that are not availed to everybody except the management and the owner. These accounts may be personal or impersonal, and they include capital account, drawings account, trading, profit, and we also have the loss account. We also have impersonal accounts. This category of ledger accounts include all the accounts that are not personal in nature. Example of account of things that are not personal in nature include building, purchases, rent, sales, and discount received. Discount received. Now, in personal accounts fall into two types. We have two types of personal accounts, and then the real accounts and the nominal accounts. When you talk about real accounts, these are accounts that are tangible, accounts of tangible assets or properties. Tangible, they are felt. That is the building. You can feel land, you can feel furniture, fittings, machinery, stock, cash, etc. You can name them. And then when we talk about the nominal accounts, there are accounts of items that are related to gains or losses and whose balances and they balance at the end of the accounting period. That they include all the expenses, the revenues, the sales, the purchases. They all they all lead to the nominal accounts. Now, some of the business expenses include parties, sales, insurance, stationery, repairs, depreciation, heating, discount allowed, lighting, interest, printing wages, rent, rates, advertising. You can name them. Some of the classifications of ledger account. Many businesses handle few transactions, hence they have few records to keep. Their accounts can thus be kept in a single ledger referred to as a general ledger. Another classification of a ledger account is a business grows, the volume of transaction increases. As a business grows, the volume of transaction increases. Now, these single ledgers therefore become very bulky in account and it becomes very difficult to make references to them. Another one is in order to simplify the recording of transactions and facilitate references to the accounts, ledger accounts are usually classified and each category is kept in a special ledger. Now we have something that is called a trial balance. What are some of the purposes of having a trial balance? Number one, it checks the accuracy in the ledger accounts as to whether the rule of the double entry has been adhered to, or has it been observed, or is it compiled? And then why? Another one is are there arithmetic errors in the ledger account? Now another purpose is it gives a summary of the ledger. That is a summary of the transactions which have been taken place during a given period. Another one is provides information for preparing final accounts such as the trading account, profit and loss account, and the balance sheet. Another one is tests whether the ledger account balance have been posted to the right side of the trial balance. Now, some of the limitations or the cons of trial balance is even when the trial balance totals are equal, it does not mean that there are no errors made in the equation. A trial balance only assures the bookkeeping that the total of debit entries is equal to the total credit entries. We have error of total omission. This occurs when a transaction takes place and nothing about it is recorded in the books of accounts. That is, it's completely omitted. Another one is the error of original entry. We also have error of commission. Now, error of original entry, it occurs where both the debit and the credit entries are made. And then now error of commission, it occurs where double entry is completed but in the wrong person's account, especially due to confusion of name. Let's go to topic 9. Topic 9 is the demand and supply. What do we mean by the term a demand? Demand is the quantity of a product that buyers are willing and able to buy at a given price over a given period of time. Now, some of the factors that determine the demand of a product, the number one, the price of a product. If the price is lower, more will be demanded. And then we also have the buyer income. The higher the people's income, the higher the demand for goods and services, and vice versa. Government policies. If the government imposes high taxes on the commodity, it becomes very expensive and less of it is demanded. And then we also have the population. With many people available, more of the goods are demanded. And if people are less the goods are demanded for. Now we have some types of demand. We have the derived demand and we also have the joint demand. Now the derived demand, a product is said to have derived demand when it is demanded to help the production of other goods and services. For example, the demand of a building. of building a material arises from the demand of houses, and we also have the joint demand. Items are said to have joint demand if the use of one will require the use of another. For example, let's use a case where you have a car. You'll also have to have fuel. So let's look at a demand curve, sorry. We have demand curves, we also have demand schedules. It's the tendency of demand to increase as price decreases, and the reduction of a price increase is referred to as the law of demand. Therefore, a normal demand curve slopes from left to right. A shift of demand curve to the right, increase in demand, can be as a result of an increase in the people's income, an increase in the price of substitute product, an increase in population, an improvement in terms of sales, a decrease in the price of a complementary product, an improvement in taste and preference towards a particular project. Now, some of the differences between a movement along a demand curve and a shift of a demand curve movement. Number one, it involves only one demand curve. The other one involves two demand curves. Another one, it is brought about by changing the quantity demanded, while the shift of a demand curve is brought by a change in the other factors that influence the demand of other prices of commodity. And the difference it involves the change in a quantity demanded, while the other one involves the change in the demand. Alafu, we also have a movement along the curve. It can be traced up and down along the same curve, while the other one, it shifts courses to move either to the left or to the right side. Let's go to topic 10. Our topic 10 is money and banking. We're going to talk about barter trade. So what's barter trade? It's a form of trade where goods and services are exchanged for other goods and services. What are some of the benefits? Number one, satisfaction of wants. Number two, surplus disposal. Three, social relation. Four, specialization. And lastly, we have improved living standards. What are some of the limitations now that we know the benefits? Lack of double coincidence of funds. What do we mean? It is very difficult to find two people with a need for each other's products at the same time. Like for instance, I want a couch, and I want a couch, and you, on the other hand, you have a bag of beans. Now you see, double coincidence is very hard to get. And then another one is lack of store value or perishability of some commodities. Now, some of the commodities that can wither out or can get spoiled are, let's use, for example, vegetables. Like I have a sack of vegetables, but the demand for the vegetables is not in hand, so my vegetables will actually go bad. And then we also have invisibility of some products or commodities. It is very difficult to divide some products, like for instance, now like you have like books and I have livestock. How do we equate all this to be one? It's very difficult. I can't divide my cow to half to match your commodity. And then we also have lack of standard measure of value. We also have transportation problem. This one, it applies majorly for the bulky goods. And let's look at the money system. Money. is anything that is generally accepted and used as a medium of exchange for goods and services. Now, some of the features of money are: number one, acceptability. Now, that item that is going to be used for a medium of exchange should be acceptable to both parties. Number two, durability. Now, the material that is used to make money, we've seen a note or a coin. Now, the material that is used to make it must be able to last long without it getting torn, defaced, or losing its shape and texture. We also have divisibility. Money should be easily divisible into smaller units. For instance, you have 1,000 shillings. Now, this 1,000 shillings note, mark you, it's a note shillings. It should be easily divided into 200 shillings, 5 bob, 50 bob, in that amount that you want to use. And then we also have cognizability. The material used to make money should be easily recognizable. Now we have functions of money. We've said it can be used for a medium of exchange of goods and services. Now some of the functions: number one, medium of exchange. It is generally acceptable by everyone to in exchange of goods and services. Number two, store value. It is used to keep assets, value of assets. Easy supply goods can be sold and then money kept in a future transaction. You can keep it in banks or safes. And then we also have measure of value. Money is used to measure value. Money can also be used as a unit of account. That is, it is a unit by which the value of goods and services are calculated and recorded, and records are kept in. We also have standard of deferred payment. It is used to settle credit transactions. We also have the transfer of removable items or assets. Money is used to transfer assets such as land from one person to the other. And that marks the end of our lesson. Hope you guys enjoyed the notes and the portal. Thank you and have a lovely day.